Welcome everyone. In this video we'll be talking about the partnerships. So partnerships are a legal structure. So when you're starting off a business or you want to put your money together with other people, you can structure your business either as a sole trader, which is an individual. It could be a company, it could be a trust, or it could be a partnership. So those are the key structures that people often consider. Partnership is very common in legal and accounting professions because it's a structure that allows multiple partners to join together and share in the profits. There's also a number of tax advantages and disadvantages, which we'll talk about later, which are distinctive from some of the other structures. So first of all, what the definition of a partnership? So there's effectively two main definitions of a partnership. So number one is the common law partnership, and number two is the tax law partnership. And then there's this third kind of limited definition of a partnership, which is called a limited partnership. So the common law partnership is an association of persons carrying on a business. That's the key distinction there, carrying on a business. And number two is tax law partnership, is where it's an association of persons in receipt of ordinary statutory income jointly. So in simple terms, if you're running a business, think a legal firm of partners, this will be a common law partnership. And if it's just two people pooling the money, the common one is just people pooling the money to purchase a house, for example, or some other kind of it's basically to split asset ownership. This is a tax law partnership, and there are implications for each of these, which we'll discuss later. So first of all, we need to look for certain factors as to whether it is actually a common law partnership. Okay, so the first one is contractual arrangement. So whether or not there is, number one, a formal written partnership agreement. An oral agreement may be okay, but it's not conclusive. Number two, sharing of profits and losses. Number three, ownership of assets. The next key category is partner contribution. So whether or not partners have contributed capital, services, labor, or other contribution. So one partner might have contributed money and another partner might have contributed their time and effort. And thirdly, the category to look for is operation. So whether or not a partnership bank account exists, whether partners participate in the control and management of the business records exist, public recognition of a partnership exists, partners have the authority to act on behalf of the partnership. So if you think about a company, let's have a look at PwC. So there would be a written partnership agreement, so all the partners would be signing this. There would be evidence of profits and losses because every year they have distribution statements of the profits that they've made as operating their tax accounting business. Each of the partners at a certain level are generally required to buy in, so they generally have a equity contribution, which would make them an equity partner. And operation, so there'd be a PwC bank account. Obviously, the partners would engage in meetings to actually run the business. There's obviously business records and a trade name, and people publicly recognize PwC. They're aware that it's a partnership, and finally, the partners have the authority to act on behalf of the other partnership. So, if one partner gets in trouble with the ATO, technically the whole partnership or all of the partners are in trouble as well. So that's another key distinction of partnership to look out for, using PwC as an example. So, some of the key attributes of a partnership, which is very similar to what are the pros and cons of it from a tax perspective. So the first one is that partnerships are not taxed as a separate legal entity. Now, if you think about what that means is, so for example, let's say you set up a company and you're going to operate your company, your business out of a company, legal entity. What that means is your company is going to be lodging its own tax return. It's going to be paying tax itself, so the company is going to be paying tax probably out of the company bank account. And if anyone sues the business, they're going to sue the company. They're not going to sue you. Now with a partnership, the partnership itself doesn't actually pay tax. So each of the partners themselves are required to actually report the partnership income into their own personal income tax returns. The partnership does lodge a tax return, but that's merely just to let the ATO know or the tax agent know, so that the systems actually have a record when they lodge it of, so that the partners actually, report that partnership income in their own, and the government can do data matching against the partnership and make sure that everyone's actually, including that income in the tax and paying tax on it. So partnerships are treated as resident for tax purposes. So that, as we discussed in earlier chapters, that means that they're assessed on income and expenditure on worldwide sources. So as I mentioned before, individual partners are assessed on their share of partnership income. So it's actually the partners themselves that pay tax. So another key distinction is that net partnership losses are not quarantined and can be distributed to offset each partner's individual income. So if you think about a company, for example, when a company loses money and it's got losses, the shareholders don't get to use those losses. So the losses sit in the company until a future year of income when they can actually offset those losses against that future income. For a partnership, if a partnership actually loses money, what happens is that it doesn't sit in the partnership, it actually gets distributed out. So when the partnership lodges its tax return, it'll say to the government, we've lost $1 million this year, and there's 10 partners. So each of those 10 partners, however their percentage split is, let's say it's even, each of them would record a $100,000 loss. And even better, they can actually use that to offset the rest of their income. So let's say they've actually got a salary, of $200,000. They're going to pay a high tax rate on that. They can use that $100,000 partnership loss, reduce their taxable income to $100,000, and pay a low amount of tax on it. So it can actually be a good way of avoiding tax. And not only that, but a partnership that carries on a business may be registered for GST. A partnership that's an employer can provide fringe benefits. However, a partner cannot be an employee. That's an important distinction. A partnership can be a small business entity. However, the small business CGT concessions only apply on a partner level, not the partnership, which makes sense. So the partnership income is taxed at the partner level. Yeah, okay. Again, we talked about that. Because the partners are paying tax on the partnership themselves, they'll be paying at their own marginal rate. So here's a potential downside to partnerships potentially. If you're a company, you're only going to pay a flat 30% tax rate. However, if you're a partner making $1 million a year, you'll be paying, close to high 40% tax rate in Australia. However, in practice, partnerships, they do have some tax minimization strategies that they use. For example, distributing to trusts and things like that, which are more tax-effective vehicles. But keep it in mind that it's the partner that pays the tax. Again, we talked about partnership losses, how that's at the partner level as well, and they're subject to non-commercial loss rules for partners that are individual taxpayers. Net capital gains and losses. So this is an interesting one. So partners own the interest in each partnership asset. Okay, so when you have PwC, it's got $1 billion in assets. So each of the partners would own their percentage in those assets. So as soon as the partnership actually sells those assets, the partners themselves actually pay the CGT on it. And then the CGT concessions would depend on the partner's tax profile as opposed to the partnership itself. And franking tax offsets are not available at the partnership level. So partnership net income is very similar to net profit in a company or another entity, and it's calculated as net income or loss is equal to assessable income less allowable deductions. Okay, so this is where it gets interesting. So how do we actually allocate that net profit or net income / loss of the partnership? So this is where those definitions that we talked about of what type of partnership it is start actually coming into play. Because each of them, depending on what type of partnership they are, has a different treatment of how net profit is allocated. So a common law partnership, which you'll remember is based on a business, is based on the partnership agreement. So the agreement might specify that one partner actually gets more than another. Now the tax law partnership, however, is based on ownership percentage. So if I've contributed 60% of the cash for a property, I will get 60% of the returns. Remember, this is the asset sharing vehicle if you're pooling money or something for an asset. Okay, so let's talk about how we actually calculate net income. So it does involve a little bit more complexity than just assessable income minus allowable deductions, because there are certain things that we exclude from this calculation. So number one, so what this means is we actually take it up in the partner's personal tax returns as opposed to the calculation of partnership net income. So number one, CGT gains or losses. So for example, we talked about before, if PwC sold an asset, you wouldn't actually include that in the partnership income. Okay, what you would do is completely exclude it, and the partners would actually record the CGT because they personally own the asset, or they have an interest in that asset. So the partners would record that gain. So you'd also exclude any prior year partnership losses because they would have already been distributed. So that's not applicable. Personal super contributions. So this is an interesting one. There's a specific thing that's excluded here. Salaries and drawings paid to partners. Now note that partners are not employees per Ellis versus Joseph Ellis Co. And finally, interest payments on partners' capital account rather than loan account. So this starts becoming an important distinction, and it's one of the more challenging thing of the partnership topic, is learning what the difference between a partner's capital account is versus a loan account. So we'll go through a good example from the CSG of how we actually determine that. But first of all, let's go through a different example in the CSG of actually calculating a specific partnership's net profit with some adjustments in here. So this is from section 9-9 in here. So it's talking about partnerships over here. So we've got an example here. So we've got a partnership, PNC partnership, which contributed equal amounts of capital. So they've agreed that Paul should be adequately remunerated for his efforts, which is considered to be $20,000 per annum. So they carry on a business. Excess capital is invested in the share market. However, PNC is not in the business of share trading. Okay, so the first thing to note is because they're carrying on a business, it's actually a common law partnership. So we talked about that definition before, carrying on a business. And the implication of it being a common law partnership and carrying on a business is that it can actually claim deductions under section 8-1 because the deductions actually relate to the income that's coming in. Okay, so first of all, let's look at the accounting profit. Now keep in mind, we need to go from the accounting profit to a tax profit. So that's going to involve some adjustments. So we've got sales of 100,000, we've got a capital gain of 15,000, COGS 50, business expense 10,000, which should be deductible. So it would be COGS because they're carrying on a business. Salary to Paul we'll come back to. So Paul is actually a partner, but he's actually got this agreed salary in there. And we've got this non-deductible entertainment. So the first thing is, well, because it's carrying on a business, we have to follow the rules of the Income Tax Act 1997, Section 8-1, which is deductions, and that non-deductible entertainment is actually, we can't include that as a deduction. So what we're going to do is we're going to add that back to our profits. So this 30,000 is going to go up to 35,000. So the next thing that we're going to do is this. We're actually going to ignore the capital gain because, as you remember, the capital gain is excluded because that's actually calculated at the partner level, not in the partnership net income. So we can ignore that. We can subtract 15,000 from our net income. Now the last thing to note is this salary to Paul. So remember we talked about Paul as a partner, and salaries and drawings paid to partners need to be added back because partners are not employees. If he wasn't a partner, that's fine. It's a genuine salary expense. But this is effectively just a cash distribution to a partner, so this needs to be added back. It's not an expense. So this leaves us with the following adjustments. So our accounting profit of 30,000, which is this one here. We then adjust for non-deductible entertainment. We add back the partner salary and we reduce the capital gain. So our net partnership income is 40,000. Okay, so let's now revisit this final excluding point, which is interest payments on partners' capital accounts rather than loan accounts. So again, I'm going to refer back to the CSG where I've got this table in here. So this is a very difficult to understand differentiation, and a lot of people have trouble with this. So where there's interest on a partner's capital accounts or credit accounts, it's not deductible, But if it's interest payable to a partner for a loan provided by the partner as a lender to the partnership, then it is deductible under Leonard v. FCT. So what's the difference? So capital accounts is effectively where a partner has just put money into the partnership. For example, there might have been the equity buy-in. So at PwC, you've got to spend $500,000 to become an equity partner. And that's going to accumulate interest because it rewards the partners for investing money in the partnership to, buy assets, generate the business, etc., and so forth. This isn't the same thing as loaning the money to the partner, in the same way that putting money into equity, into the share market, is not the same way as loaning money to, Apple. Buying shares in Apple is not the same as lending money to Apple. So if you lend money to the partnership, generally there's a loan agreement, there's generally fixed repayments as well as fixed interest, and generally there's a fixed term that it's repaid by. It might be a 5, 10, 15-year loan. There might be security, and if it's a loan agreement, then the debtors always get priority in repayment over the capital or over the equity. So it's very similar to a company. It's the difference between debt and equity, effectively. So the debt interest payable to a partner would be deductible. However, it's just on capital accounts. Think about it as equity. Then it's not deductible. So there's just one other very small point to be aware of, is that black hole costs are only deductible for common law partnerships and not tax law partnerships. Okay, just a small point. Now, the CSG also talks about joint ventures. We don't really go into much detail in the CSG about them. Just as a high level, they're different from a partnership. What it is an arrangement between two parties for a particular transaction. So the product, it's usually about a product as opposed to profit, and it will be shared as mutually agreed. So it's usually temporary. It usually might be for a single project. It might be for commercial reasons or tax reasons. So think about recently Toyota and Subaru came together to produce a Subaru/Toyota hybrid sports car, the BRZ and the 86. So that would be a joint venture as opposed to a partnership. So it's one-off. They weren't actually sharing any other part of their business, just this one project, and they had an agreed split of profits. There's also limited partnerships, which I mentioned before. This is basically a hybrid between a company and a partnership. So what it does is it actually provides limited liability to the extent of capital contributed, whereas other partnerships don't actually provide limited liability. Just to recap memory, limited liability means that shareholders aren't liable to pay anything further than what they've already contributed in the business. So actually a lot of large professional partnerships are actually limited partnerships. But again, it's not really something we go into a lot of detail in this course. We just focus on the two main types of partnerships predominantly. So here, the notes and the CSG go into a lot more detail about this difficult to understand partnership borrowings. So we mentioned before that it's deductible on loan from the partner, but capital account interest is not deductible. It does get a little bit more complicated than that, because there are a few situations which it is actually deductible as well. So the deductible situations is, number one, the partnership borrows money to fund working capital or buy income producing assets. So the interest on that would be deductible. However, you must determine the purpose of the loan under section 8-1. So there must actually be a nexus to generating income and deductible on the 8-1. So the next is the refinancing principle. So this is basically when the partnership doesn't have enough money to pay out one of the partners that's leaving. So think about PwC again. Let's say that all their cash is tied up in a new rollout across Asia, but at the same time they've got a number of partners exiting and they need to repay their original equity contribution. I shouldn't say equity contribution because it's not equity. I'm just saying that so it's a little bit easier. It's actually capital contribution on the capital account. So if PwC doesn't have the working capital to repay it, what they might do is borrow money to pay it out, to actually repay those. So if the capital account is still in credit after repayment, it is deductible after the refinancing principle. If it is in debit, it is not deductible. And then finally, the last deductible situation is refinancing of partnership capital Interest is not deductible in respect of the portion of the loan paid to partners that is debited against unrealized profits. So this one's pretty hard to understand as well. Unrealized profits could be a revaluation of an asset upwards. It could be foreign exchange movement. It could be an unrealized capital gain. It could be the recognition of goodwill. So these aren't actually cash profits, but they can be recorded as revenue and then put to retained earnings. So similar to a dividend paid out of retained earnings, this the interest is not deductible in respect to the portion of the loan paid to partners that is debited against unrealized profits. Okay, so just look out for anything in a question that may relate to an unrealized profit, so a revaluation of an intangible, effectively. So what about some situations where it's not deductible? So interest payable by the partnership on borrowings to pay personal income tax is not deductible. So as we mentioned above, there must actually be a purpose test of the loan. So they can't just use the repayment of the repayment of the loan. Sorry, the repayment can't just be for personal matters. It must actually be for related to carrying on the business. And again, so similar to revaluation of assets, which we mentioned above, any interest on borrowings to replace capital internally generated from revaluation of assets not yet realized is not deductible, so as we mentioned above. So just to recap the steps of actually calculating partner taxable income. So this brings it all in together. So first of all, calculating the net income of the partnership. But then there will also be some other adjustments. For example, capital gains, which we excluded from the net income, but we actually need to bring that back in at the partner level. So this is what we're going to be doing now. So step 1, allocate net income of the partnership. So we talked about that above. So determining whether it's income or equity method, depending on the type of partnership it is. And making certain adjustments, as we talked about above. Next step is to determine the assessable and deductible amounts recognized at the partner level. So interest and income expense in respect of loans to the partnership. Partners' personal super contributions. Remember we excluded that up the top. Prior year and losses carried forward. So because the partner may actually have losses accumulated, they may be able to apply it at the current year. Capital gain or losses. So for example, the PwC selling assets is recognized at the partner level, even though it's not in net income, it is recognized here. So you've got to add up the net income plus all of these adjustments. And then that calculates the taxable income for the partner. Okay, so let's move on to acquisition and disposal of partnership assets. So this is really interesting and unusual. So basically, whenever a new partner is admitted to a partnership, the old partnership is dissolved, it's gotten rid of, and a new partnership is created. So imagine all the large partnerships like PwC, KPMG, EY, all those large firms. Every time they admit a new partner, a whole new partnership is created. It's ridiculous. But obviously not a lot happens, and not really anyone knows that it happens. It'll just be a signing of a legal document. And there's some tax implications as well, because when you dissolve the partnership, you actually have an event where you actually sell all your assets. So your trading stock, your WIP, your depreciable assets, and your capital gains as well. But fortunately, there's tax concessions in the Income Tax Act 1997 that when you're dissolving and creating a new partnership, all of those assets effectively just roll over across to the new partnership. So you'll remember from the previous videos that when you dispose of a depreciable asset, a balancing adjustment arises. So this will occur unless there's a joint election made by the partners to defer the tax. So this is section 40-340. So this is what I was talking about. So each of these events are going to have this special loophole in the Income Tax Act 97 to prevent this from causing tax issues every time you create a new partnership. You basically have an election, a joint election amongst the partners to defer it, and then the cost base just gets rolled over to the next entity. So there's no capital gain, there's no balancing adjustment event, and there's no notional there's no income tax income effects. So for trading stock, again, a notional disposal of trading stock by old owners to new owners at market value. So if you make the election, this time 70-90 for trading stock, this does not apply and a deemed disposal occurs which at the value at which the trading stock was recorded, e.g. at cost, not market value. Okay, so basically you're selling it for cost, so there's no tax impact for trading stock, there's no revenue recorded, and the new the new partnership then records it at cost as well. So you're just rolling forward your cost base, so there's no revenue impact. So this election can only be made when trading stock becomes asset in new business. Former owners retain an interest in stock at least 25%. So if you're rolling forward the same partnership and maybe you have 100 partners and you're getting rid of 5 and you're getting 4 more, you're going to have 90+% similarity. This is just to prevent people from gaming the system and just rolling over into another business. They actually need to have at least 25% ownership in that new partnership. Same owners as last time. And the market value of trading stock is more than the book value. This is to avoid gaming the system as well. And then WIP as well. So you'll remember from earlier videos that there's also an implication when you transfer WIP. So you'll remember that WIP is generally recorded as revenue as it's incurred or performed. But there are certain deductions and impacts if you actually sell a business with WIP to another business. So if the new partnership actually pays the old partnership for the WIP, which generally isn't the case, then there's a deduction for the new partnership available to the extent that it was paid, and to the extent that a recoverable debt has arisen, or the taxpayer reasonably expects a debt to arise in the next 12 months. So basically, the partnership could use the transfer event as an opportunity to write off some of its debt, and it would get a deduction for it, provided that there is a debt to arise in the next 12 months after payment. And then, of course, CGT at the partner level. So if you're going to sell a capital gains item, you're going to trigger a capital gains event. So because each partner has a percentage interest in each CGT asset of the partnership, it doesn't actually trigger a change in the ownership of the CGT asset, because not only do they own a certain fractional interest in the assets, but there will be a change in ownership of that percentage interest if they're welcoming new partners into the partnership. So what there is this is rollover relief, which is in subdivision 122B. And this is available to the partners, not the partnership. As we've discussed several times, it's available to the partners as they own the assets, not the partnership, who roll over assets to a wholly owned company, or where an asset is created by partners in a wholly owned company. So basically, same situation, the cost base rolls forward under subdivision 122B. And that covers the topic on partnerships. Look forward to the next video on trusts.